Just a little bit about SoftTech. We're a very active micro venture capital fund, so we focus on seed stage investing, I mentioned, mostly consumer web and mobile startups. And we're probably one of the early micro VC funds out here in the Valley. There's a number of other folks that kind of do similar things to us, but we're bigger than a single angel, and yet we're smaller than a traditional fund. So, yeah.
Can you translate that into the ticket size?
I will do that.
Okay.
Yes. So just a little bit about our background and sort of what the fund looks like. So currently we have 3 funds under SoftTech, 1, 2, and 3. The first fund was actually just a simple super angel fund. It was our founder, Jeff Clavier, who is a pretty well-known super angel. He's on Twitter as @Jeff. And it was about $500,000 kind of in and out of a number of companies. And we'll talk a little bit about how he got his start, which is sort of how he built out his network to really grow SoftTech to where it is today. And then the second fund was still Jeff as the sole investor, but we did have outside money in that fund. So we had actually LPs, and it was a $15 million fund. And at that point, the check size was probably anywhere from $50K upwards to possibly even $200K per deal, but still relatively small bite sizes. And the real purpose of Fund 2 was about access into great deals. And that was really the first institutional fund for SoftTech. And now we're currently investing out of SoftTech VC3. It's a $55 million fund. And our average check size today is around $500,000. So we'll do about 1 to 2 deals a month. So out of each fund, we've done, well, Fund 1 was sort of atypical. It was around 30 some odd investments. Fund 2 had 65 investments, and this current fund, Fund 3, will do anywhere from 60 to 65 investments as well. And in Fund 3, we have about half the fund reserved for follow-on, and so we do have a follow-on strategy of doubling down on winners. However, we really don't lead Series A investments. And part of the thinking around that is that we're not competing with our friends at the later stages. In essence, we're a really great source of deal flow for them, bringing them highly filtered, qualified deals. And we do, however, exercise our pro rata rights and ideally try to get in as much as we can into those companies as we identify the real winners in the portfolio. And that from time to time you're able to do that, and then frankly there's other times where the pro rata just isn't available in order to get later stage investors in, and that happens too. To date, we've done over 130 investments since 2004. I think we just hit our 40th investment out of the current fund, with later stage investors, and we've had over 1.25 in exit considerations. So nothing in the portfolio has gone public yet, but we've definitely had some great exits, and that's on my next slide. So some of these names may look pretty familiar. The most recent exits we've had actually don't. So out of our current fund, our first exit has been Card.io, which was acquired by PayPal over the summer. A couple other recent ones. I actually don't even know if this is completely up to date.
What about
Wildfire is probably the biggest one most recently, which was acquired by Google not too long ago, and was a pretty exciting exit for us. And
the Victoria.
That was great. Oh, there it is. It's right here. So we've got this a little. I got this a little out of ranking here, but so that was a big one. Bleacher Report also just exited as well. So that was another big one. It was acquired by Turner. So we've had a number of pretty brand name startups actually being acquired by brand name technology companies and whatnot. And so obviously exiting to an acquirer is one option, and we'll talk about that as well. So here's a look at it's kind of hard to see on this, you can't quite see the grid, but here's a look at some of our current investments. And what we invest in as seed investors has evolved over time and will continuously evolve in terms of the areas that we find interesting to look at. And that's partially because the trends change, and what's not necessarily what's popular to invest in, but really where the opportunity to invest will shift. So whereas 5 years ago, social media would have been a hot area to invest in, now it's much more tactical. It's just an element that all of our companies utilize. You can make the same argument with mobile these days. We still do a lot of investing in mobile, but mobile is a component to a lot of the companies that we invest in as well. So just taking a look at some of these, probably Fab is the largest one on here that many of you may be aware of. We do a tremendous amount in e-commerce and next generation commerce, including not just traditional e-commerce, but also things like marketplaces. Mobile-enabled services and infrastructure is another big area for the fund these days. We're investors in companies like GigWalk and Postmates, companies that are really leveraging the fact that everyone has this in their hand and we can really transform workforces as a result. And then the third area we spend a lot of time on is SaaS, both vertical and horizontal SaaS. So we're in companies like StyleSeat, which is an open table for stylists. We just did a deal last winter in a company called Farmeron, which is actually originally out of Croatia and split their time between the Valley and Croatia. And it's a SaaS solution for farmers, specifically focusing on milk farms and the data coming out of milk farms to start. And so we definitely look for investment opportunities in verticals that have seen limited technology enter, and there's a lot of opportunity not only with cloud but now with mobile. And then one thing I'll point out that we have within the fund is opportunistically we've had this new areas place to experiment. And excuse me, I'm going to apologize right now. I lost my voice about 3 weeks ago, and it's still just coming back. So my voice may come in and out as I'm talking. I was actually told by my doctor that I should only talk for money-making activities because I use my voice professionally. So I'm not.
This is it.
Yeah, this is a money-making activity. It's a work-related activity, and so therefore I can talk. Otherwise, I've been told not to talk, which I'm not too good at following that advice. So new areas, a couple things to point out there. I think Fitbit's a really interesting investment for us. I don't know if any of you have a Fitbit around the table, but it's a tracking, health tracking device. They now have a scale. They actually just, I think the one is now available for purchase. It's the new updated version of the Fitbit in stores today, I think. But essentially, connected devices and hardware is something we typically don't invest in, but liked the hardware software. Jeff did that deal first back in 2008, so we were early investors there. But really, we have this new areas as a way to opportunistically look at areas that we may eventually, over time, become their own category in the fund. One area that I can point to where that's happened is education technology. So a year ago, we just did our first EdTech investment, and it would have been, I think it still sits over in that new areas. It's a company called Class Dojo, and it's an application for teachers in the classroom to begin to monitor behavior. And it really goes towards this broader play around the measurement of character, a lot of things that have come out of the KIPP School of Thinking. And it's got a very consumerized approach to entering schools. It doesn't rely on the school district or even the school level approving the application. It's something a teacher can download for free. We have millions of students on it, hundreds of thousands of teachers are using it. But it was a new area for us to go into education. And certainly it's a new area within education. Within the last year, we've done 2 additional EdTech deals. And Class Dojo was a way that we kind of got to really begin to get interested and begin to understand the space. And so since then, we've done a company called Top Hat Monocle, which is actually out of Toronto. And you know
It's
them?
actually one of my companies
Oh,
went to the
great.
expo at Rocket Space.
Awesome.
I was going to ask you next. How many of those companies are
We have
international?
2 Canadian, so I'll tell you which ones are international. So we have 2, so Top Hat is a classroom clicker, turns iPhones and regular phones and desktop into ability to pull in the classroom, so focused on higher ed. And then the third investment we did in EdTech is a company called Clever, which was out of the most recent Y Combinator batch, and essentially is an API for student information databases. So essentially, all the student data that resides in the database at the school, how do you get that easily in the hands of developers so that their applications can be used much easier by teachers and by parents? And so we've done 3 investments in a space that a year ago we had nothing in. And so I think, and you'll, as you think about your angel investments and those of you who are running incubators, you will begin to see trends and things begin to emerge. We're constantly shifting our thinking and exploring new areas, but we still look for consistency in types of business models and themes that we understand as investors that allow us to kind of leverage what we've learned across the portfolio. In terms of what's US versus international and geographic split, I think is a great question. We have only a handful of international investments, and I would almost consider Canada to not, it's international for us, but it's still close enough. So we have 2 investments out of Canada. We have Vidyard out of Waterloo, and then I was actually in Waterloo not too long ago. And we have Top Hat out of Toronto, but they also have a presence here in San Francisco. I think we have 1 deal here that's based in Europe. It's highly unusual for us to do a deal in Europe. That's Blink Booking. We certainly don't. We occasionally from time to time we'll do a deal there, but we don't tend to look for deals coming out of Europe. And then for the most part, though, our 75% of our portfolio is based here on the West Coast, split between small Mountain LA and then really just the Valley, and primarily San Francisco these days. A lot of the consumer tech has just moved slightly north from where we are right now. And so that's the majority. About 10 to 15% of the portfolio is based in New York, and we continue to see interesting opportunities emerging from New York. We actually don't have anything in Boston, and we have a handful of companies based in Boulder. And traditionally, when we think about how we invest outside of what we consider the local home market, which would be here in Silicon Valley, we look for building syndicates with strong local partners on the ground. So anytime we're doing a deal where we're not necessarily down the street, we try to find local investors, whether it's an angel or another micro VC, who we know is going to be a little bit closer. And we think that's very helpful to not only ourselves as investors not being next door, but also to the founders themselves. And so that's part of what we think about as we think about putting together syndicates and working outside of our home market. And and that's evolved over time too. When we started out as a fund, all of the deals that Jeff did when he was a solo investor were based here, and then slowly over time he started investing sort of outside of the Valley. And really it was having friends in other cities that could bring us good deals and vice versa. So any other questions I can kind of answer about the portfolio right now? Otherwise I'll kind of dive into the meat of the talk. So basically what we're going to talk about today is getting from starting and finding good deals to actually getting to close. And then if we have time, I added a few slides in here about portfolio management. I don't think there was a lot of talk about that, and so I thought it might be just a little helpful to touch on some of those points. So I think sort of top of mind is how do you begin to attract good deals? And there's really two ways you can do it. You can do it the value-added way or the non-value-added way. So we'll talk in depth about the value-added way, and then if there is no intrinsic value to offer, we'll talk about ways that you can start to think about doing that. So the first way is really the value-added way, which is to define your value add. And what that means is, what is it that you've done in the past? What is it that you're bringing to the table for the entrepreneur or for the company? And so it could be prior executive experience. It could be experience as an investor previously. It could be access to a network, a platform company network. It could be expertise in a particular operational area. But essentially, you want to really begin to think about it. What is the unique thing that you're bringing to the table as an angel investor? What is it that separates you from others? What is it that you're bringing some unique insight that can be helpful to that particular deal and to the portfolio that you intend to build as an angel? One thing to do is really to hang out, network, and get to know and meet great entrepreneurs. And so there's a lot of hangouts. I mean, you guys obviously run one, right? There's a lot of great ways here locally, and if they don't exist in your local home markets, it's something to think about how you get together groups of people that are focused on entrepreneurship, that are really interested in getting to meet other entrepreneurs. Other entrepreneurs are great sources of deal referral. They're just different ways in which you know people network. And the more familiar you are and the more people begin to see you at events, at speaking engagements, things like that, it's just another way to kind of solidify yourself within the community. Okay. Another way that you can begin to give value-added feedback before you actually get into deals is really try to be helpful. And that's listen to entrepreneurs give pitches, give some feedback. Try to offer to connect them to one or two individuals that can be helpful. You may not be ready to invest, they may not be ready to take your investment, but really getting out there and beginning to be helpful within the entrepreneurial community, being selective about the companies that you're helping, really making sure that you're helping companies in a way that they can turn around and talk about the help that you're giving to them, even though you're not necessarily putting dollars in. You're giving your time right now, and that will come back. Most of the best referrals that we get as VCs are actually coming through founders in our network, founders whom we've invested in, founders who we haven't invested in, who just know us and know our reputation. And so I think, thinking about how before you have any dollars in a company, before you've actually begun even angel investing, how you can be helpful in a way to begin to build your reputation as someone who could be a good advisor. So offer to help. Another thing we have on here is hustle. It's really all about the hustle. Getting into a deal means really selling yourself and selling the value proposition that you've identified. One of the ways in which we get into deals and can get into deals very quickly is, people understand the soft tech platform and the brand and the value of the portfolio we bring, but we work hard to get into those deals. And so it does take getting your brand name out there. It does take, getting out there, working hard to be known and to have others be able to talk about you and know a little bit about you and what you bring to the table. And so develop your reputation. There's a lot of different ways you can do this. There's ways that you can, again, you can do that through advisory things. You can do it through giving talks. You can do it through drawing from your own personal experience and helping founders in small settings to deal with specific problems that they're facing in their company. If you're an expert in marketing, can you begin to give talks around customer acquisition? A couple years ago, blogging was a really great platform for angels to begin to get their brand out there. There's a lot of people that blog these days. So, it's sort of okay, you need to have some sort of online presence, obviously, but really think about the ways you could be different, the way you can stand out. Even if it's just, small ways, you're not necessarily driving a ton of traffic to your site, but you have meaningful things to contribute to the broader conversation. I'm sorry, I'm trying to read all of this from a distance, which I'm not so good at. And so I may look behind me. And then finally, again, it really is about building your own personal brand. What is it that you're doing that is consistent, that people begin to recognize when they hear your name? They know the 3 or 4 things that you're bringing to the table. And I think that consistency is very important. You can use a number of social media channels to hammer home that consistency. The companies that you begin to advise will hammer home that consistency. One of the areas that I've spent a lot of time investing in over the course of the last year and a half, in addition to education, has been next-gen commerce. And now when I meet later stage investors who, Series A, Series B, who aren't ready to do the deals are too early, I'm actually one of the names that comes up quite frequently is, oh, you should talk to Stephanie at SoftTech. SoftTech does that a lot, and Stephanie actually looks at those deals. And so just getting out there what it is you're looking at, getting out there what those things that you're interested in and where you can actually have very value-added conversations, whether or not you choose to do the deal, is very, very helpful. So it's really about just once you've defined that brand, how do you then hammer home what that brand is? And then finally, building your track record. I mean, the first couple of deals that you do, think very carefully about. Those deals are deals that you will look back on and reflect back on as the foundation for the brand that you're building as an angel. And so whether you're an incubator, like looking for those 1 or 2 deals in that first incubator class that are really going to help you begin to show and to demonstrate to the next wave of founders in an incubator, this is sort of the bar. This is what we're looking for. There's a lot of signaling that obviously goes on within the portfolio. And again, as I mentioned, our founders are some of our best sources of referral. We really trust our founders. They're people we've given time and money to, and so therefore when they come to us with a recommendation, we take that very strongly. Okay, so the other way, if you can't exactly define your value add, and it sounds to me like everyone in the room doesn't necessarily have this difficulty, but if you can't define your value add, there are other ways to begin to get exposure and to get into deals. One is just to align yourselves with other investors, and I would say again, potentially as other people that are there locally, or other people that you know within your network, folks that can actually help you get into a deal. Maybe you're just money on top of the initial money, so I'm just going to do a follow-on. I think it's harder to do that these days, particularly in areas that are crowded. As you're talking about other markets outside of here, outside of I'd say New York, outside of potentially hotbeds like Israel, you actually very well may be able to piggyback off of another local investor's investment. So someone locally is putting in $50K, you say I just want to follow on with $10K to your investment, and that's one way to begin to get into deals. And really, it's about finding a mentor, finding someone who can help you begin to think about how to structure your own thinking as an angel, someone who can make introductions for you and help you again kind of get into that network. Again, I mentioned the shadowing investments, so finding 1 or 2 folks that have a solid thesis that you want to get behind. Again, I think it's easier to do in secondary markets as opposed to markets like this one. And then, it's just about being a good person, right? Listening, learning, how do you complement what they're doing? And eventually, I think you really do begin to figure out what that value add is. And I mentioned it's tough to do the non-value added way outside of, in very hot markets. In new emerging markets, there's more of a need for capital, period. And so there's more of an opportunity to lend capital and then begin to grow as an investor to add more value over time. The value you're giving is capital that isn't necessarily accessible in those markets. Wow. All right, let's do a little bit of
Backup happening there.
Let's see here.
There it is.
All right, we're back. Okay, so any questions about attracting deals before I move on to the next? Okay, so I'd say once you actually get the pipeline and you begin to develop your funnel for great deals, you've got a great network, you've got a brand, and you really start getting your deal flow coming in, this is actually probably one of the biggest challenges you'll begin to face, which is how do you filter through good deals? And I would argue this is probably one of the biggest challenges that we have at SoftTech in terms of, we've got a great pipeline of deals now. We can't possibly meet and see every deal that's out there. We can't possibly meet and see every deal that's been introduced to us. And so we have to really develop our filter. We've had to really learn to develop our filters over time. And I think that filter continues to evolve and grow as we grow as a firm. So, first and foremost, you really need to have an investment thesis. And I talked a little bit about ours. We have a couple sectors that we look at. We have a bite size that we do a certain amount. We focus on seed stage. We also primarily have a geographic focus and a way that we think about investing outside of basic geographies. So a couple ways that you can do this. You can have a sector focus. You can say I'm only going to invest in companies that are enterprise software companies, or I'm only going to invest in consumer mobile companies, or I'm only going to invest in next generation commerce, or I'm solely going to focus on marketplaces because I'm a marketplace expert and know how to grow marketplaces. And so you'll evolve thinking around a particular sector. Second is location, and that's a very, very valid way to segment deals. If you only do deals in Boulder, then you're not and you only do enterprise deals in Boulder, then you're not going to consider a startup based here in Silicon Valley that does mobile networking, right? So, being disciplined about defining what it is you're going to look at, and then being cutthroat about not looking at deals that don't fit that thesis is one way that you can begin to filter. It's also another way as you're beginning to build credibility in a space and to begin to be able to recognize patterns. You want enough leeway within the portfolio that you're building out as an angel that you don't have companies competing directly with one another. But at the same time, you're going to want to be able to leverage what you're learning from one to the next. And so I think it's really, really important to have that thesis. And again, that goes back to talking about that thesis publicly, having that thesis available on things like AngelList and on your blog and on your website if you maintain something like that. So we have a rule at SoftTech. There's the criteria that we use to look at our deals. We have something called the 3 S's rule. And it usually gets a couple of chuckles. So there's 3 things that we say we look for in deals. And this is our SoftTech rule. In fact, we've actually, I think we're now gonna, Jeff wrote a chapter in it about it in a book. We talk about it on panels all the time. For us, there's 3 things we look at. We look for a smart-ass team with a kick-ass product in a big-ass market. And so I'll talk a little bit about what that really means for us, because I think that's actually incredibly important. So, and the reality is you'll find your own way in which the criteria in which you look at deals, but these are the 3 things we always ask ourselves about every deal. And funnily enough, Jeff, Charles, and I don't take meetings all of that often together. Most of the time, you pitch one of us one-on-one, you pitch the next one, you pitch the next one. We actually like to do it that way. But once in a while, all 3 of us are meeting at the same time. It's about a month and a half ago, founder was in our boardroom. And I think this is the first time this ever happened, and I just didn't make the connection right away. The founder was very excited to be talking to us, and he says, I really like your 3 S's. And I'm thinking, oh, wow, that's really bold. And I realized he did not mean our 3 S's. He actually meant our 3 S's rule. So there's a first for the way that the 3 S's rule can be interpreted. But so that's how that's our really quick criteria. And when I get a deck I think about that. I look at the founding team, I look at the market they're going after, I look at do they have a product, do they have a prototype. Additionally, the other criteria I would say we think about are, right now is the size of the deal, how much they're raising. I think that's important for us. As an angel investor, that's the criteria will be slightly different. You'll still probably only focus on seed deals, but your threshold may be much smaller deals than would be our threshold. And we also do think about follow-on and fundability down the road. So is it a really competitive space? Are there some other competitive deals out there that have deeper pockets that may make it tricky for later follow-on funding? Again, that's a different, as an angel investor, your outcomes that you're looking for are slightly different than our outcomes, so that will be potentially less of a concern for you. But let's talk a little bit about the three assets. So at the end of the day, the smart-ass team is actually, I think, the most important component of what we're looking for. And you can sum it up as the 3 Ds. We look for design, we look for developers, and we look for distribution. So starting with distribution is the business thinking. It's the person on the team who's going to bring the business sensibility, who has an idea of how you will get out there in the market and potentially how you will monetize later. Design is obviously a really strong component to the product. How does the product fit? What's that user experience look like? And then the third piece, obviously, is a development team. It's really difficult to invest in a team that doesn't have at least some technical experience in-house. It's rare that you find all 3 of these things in one founder. Typically, you're looking for as much of this as you can in a founding team. I would say for the most part, we like to see founding teams with at least 2 co-founders. We've definitely invested in solo founders before. We've invested in teams of 3, maybe even up to 4 founders. Once you're getting above 3 though, it starts to get a little tricky in terms of you may have a founding team, but really the co-founders are you only can have so many people that are really leading the direction. And again, it really goes down to limited resources. And my guess is that most of the deals that you'd be considering as angels, potentially, there are just the co-founders at this point. And they may not even have anybody who's outside of that team. But really what it comes down to is this team's ability to execute on the idea. Because this is the team that's going to get the deal that you're investing in to the next level. You're not necessarily bringing on any more senior management at that point. So really focusing on your ability to read that team and that team's ability to get out there, get a product in the market, learn what that product is doing in the market, make smart decisions. That's what you're looking for. Okay. Before I go to that, I'll mention just kick-ass product. It's a product that has a good fit within the market. We like to see a prototype. Again, that's the difference between an institutionalized micro VC fund and even an early angel. An early angel may be okay investing in just concept, potentially just wires. We do like to see some semblance of a product. And again, that's a swinging scale based on the experience we've had working with an entrepreneur before in the past, and the team, what we know about the team's ability to build and execute. There are times where we actually need to have a live product see users, not necessarily see revenue, but see path to revenue before we're comfortable investing. And that will vary based, again, on the team, based on the market, and based on just what's going on in the broader market right now. And then, obviously the third piece. For us, we look for at least $1 billion opportunity. And that's because we want to know how that company gets to, say, $100 million in run rate, so 10% market share. It's not reasonable to expect that they're going to own an entire market. And so that's why that billion is sort of the minimum threshold for us. And again, as an angel, you may be okay going after a deal that is smaller than that, but then there will be some limitation as to whether or not that's going to be a venture backable opportunity down the road. But again, can still have really good exits from an angel perspective. And we can talk a little bit about that type of thinking a little later, but. So that's our threshold. Your threshold may be slightly lower. It may be slightly lower based on the market that you're operating in as well. But that's really how we think about things. The next thing I have up here is ask domain experts. And that's a really important one. I mentioned we do 1 to 2 deals a month. We look at deals across a number of different sectors. Certainly, a lot of our investments deal in areas where none of us have personally worked. So certainly none of us were farmers in the past. So the ability to look at a deal like Farmeron, we understood the SaaS model, we certainly understand distribution, but did we have insights into what farmers needed? And so one thing that we do is we reach out to experts within our network, whether they are founders in our current portfolio, whether they are people we've had business relationships in the past, people that we know that know more about a particular industry than we do. Because a lot of the time when we look at a deal, we actually are not an expert in that particular industry. And so we leverage our network to the extreme in order to get to understand a deal better. We're not necessarily looking for these experts to tell us, is this a good deal or not? What we're looking for is to understand the viability of the deal. So if you're looking at something in the payment space, and none of us on the team are an authority within payments, we may need to know just base legality. Is what they're doing legal? Will what they want to do work? From a technical perspective, is this even possible or feasible? And so we actually leverage our experts in our network very much for questions like that. We make the determination about the end of the day as to whether or not the business is interesting to us as investors and a large enough opportunity for us to invest in. But we certainly leverage our network as a way to understand the viability of a lot of what the companies we're looking to do are. And I think those conversations can actually be very beneficial to the founders too. So you want to make sure that as you're connecting founders in the network to the experts in your network, you're thinking about how that conversation can be mutually beneficial. Because again, we all know founders have limited time, and as do many of the people in your network that you're trying to connect. And so I think that can be an interesting opportunity to open a conversation. And over time, you'll figure out who those go-to people are who can quickly look and help you evaluate a deal from an industry perspective. At the end of the day, though, one thing we like to do, one thing that I think is actually really important, is sleeping on it. The first couple deals you meet, you will love. They will all seem great. I remember starting out, and just thinking every company, oh wow, this is such an awesome idea. And the reality is, it's just the first few deals you're seeing. You're limited in what your purview will look like in the very beginning. And so you'll develop that filter again over time. The first deal you meet is not the first deal you should do, and most likely. There's exceptions, obviously, to every rule. But at the end of the day, you want to ask yourselves, do you like the founder? The reality is this is the person you're backing. This is the person you're going to get to know personally. You're entering into a significant relationship with this individual. And so do you actually like this individual? Do you want to sit around the table with this individual and help this individual build a business? And I think that's really important to ask yourself. Are you passionate about the product? Is it a product that you understand? Is it a product you feel strongly about? If you can't answer yes to these two questions, then you shouldn't be doing the deal. And I mentioned, at the end of the day, you've got to love the deals that you're in. And if you don't, you will love every deal that you meet in the beginning. So just recognize that and kind of be patient until you get to that one that really makes sense to start. And again, that really means going back to those filters that you've developed in the beginning and setting out a clear thesis for how to do that. Any questions about filtering that I can answer before we move on? You potentially meet deals. You may meet a company several times before you get to decision. I mean, you're making decisions. In the most cases, though, I know that those of you running accelerators and incubators will have a different process. But as an angel, you may meet a deal once and make a decision. You also may have several meetings over the course of an extended period of time with the founder before you get to a decision. I think at the end of the day, recognizing not just the founder's timelines, but also just respecting their time, I think, is very important, and keeping them up to date on your thinking is very important. I think that's one thing that I've learned in the course of the last year. Telling people no when you're not interested is actually really valuable. It's really respected. I've actually gotten a lot of interesting introductions from founders I said no to, and I think that's because a lot of people don't say no. And so it's one data point, but there's like little things you can do to respect the fact that they're giving you time, and time is something that's very hard for them to give at this early stage. So there are little ways you can build your reputation. Okay, so that's how we filter through deals. Okay, so then the final step is really getting to closing. And so you're entering into a contract, obviously, between you and between the startup and the other investors. There's two ways you can structure it. I'm assuming most of you on the table are familiar, but you can either do equity, which I think is easier. We prefer equity deals, but a lot of the really early deals will just be convertible notes. You may or may not have a cap on those deals, depending on how early you're getting into a deal. The most important thing to do right now is to get a lawyer. Do not try to do this on the cheap. There is absolutely no reason not to spend that money up front, because the 5 to 10 grand that it's going to cost to structure a deal correctly today is worth it, as opposed to the 50 to 100 grand it's going to cost you if you fucked it up. So excuse my French. There's just absolutely no reason not to get a lawyer. And if other people are on the table, the founders are saying, oh, we found this way to do it on the cheap, I've got these documents I got off the internet. No, get a lawyer. And make sure the founders have a lawyer if they don't already. It's just, it is way too expensive not to get a lawyer. And then, we actually, so valuation, you'll discuss that again. That may not be set by you based on, especially as an angel, there's different, you potentially are working with a lead, the lead will put down the term sheet. There will be some key terms that you'll negotiate. The reality is there really shouldn't be a lot of back and forth negotiation, maybe around the price of the deal, the pricing of the deal. But we use standard Series C documents at the seed stage. If you go to seriesseed.com, our firm was actually involved in helping to get those documents done. They're very plain, vanilla, standard. The reality is a lot of terms will get renegotiated in later stages of follow-on funding. And so going with the very basic standard document will save you in terms of legal costs. You won't pay exorbitant high legal fees negotiating each individual term. And it's also just standard, and it makes for an easier Series A. You don't want some weird kludgy terms in there that are actually going to get in the way of follow-on investing later on. One other thing I'll just mention right now, between doing equity and convertible notes, at a certain point in time, depending on how large the deal is getting, you're really going to want to think about converting over to equity. Equity, you're getting upwards to $2 million around. You don't want to do that as a convertible note. It just makes later stage funding again get a little trickier. So there's a point in time in which I'd say, based on the size of the round, I wouldn't even have the conversation about doing a note. You really want to try to do that priced round at that point in time. So most of you will not be the lead investors, is my general assumption, and so typically someone like us are actually negotiating the terms of the deal, the prices, and how much allocation you'll get. And so one thing I'll mention in terms of allocation, and this goes back to how do you get into deals in the first place. When it comes time to make tough decisions, hot deals will be oversubscribed. And there will, even in down markets, there will still be hot deals. And so how do you make sure you get into the cap table, and how do you make sure you get into the deal in an amount that's meaningful to you? And that's really being able to clearly define that value proposition. Having a founder really go to bat to want you in that term, or having the investors around the table know your value proposition and understanding what you're bringing to the deal. So again, every deal you do is about building that reputation. It's what's the value add that you're going to bring? Certainly as a later stage fund, or larger fund at SoftTech, part of our value is that we have deeper pockets, and we can put more money into companies, in addition to the network that we bring, in addition to the experience of investing in over 130 companies. What is the thing that's going to make a firm like ours interested in having you as one of the 3 to 5 angels that gets to get into the deal? And so, we certainly, the other investors around the table will have some influence in who makes it into a deal, and the hotter the deal, the more value added you look to really make sure you're building out that syndicate. So I think, again, it really goes back to building that brand. Traditionally, most of the heavy due diligence lifting is going to be done by the larger checks in the deal. So once we put down a term sheet, goes to the founders, their lawyers will review. It goes back and forth in a diligence room with our lawyers and their lawyers. They handle most of the lifting there. And then at some point, we'll coordinate a closing. We'll get everybody the wire information. Everybody has a date in which we wire the money, and it's pretty straightforward. And then finally, you're committing money to the company. You're potentially committing other resources to the company, and then essentially someone may join the board if a board exists. And again, that could be you as an angel investor, It's generally the larger shareholder that's going in as an investor that's going to join the board. And in many cases, there isn't a board that's formed. My advice for companies, and we talk a little bit about, I don't know how much, we're at 5 now, so.
Yeah. So we've got a panel. I don't, I hope. We're going to have a panel straight after this.
Okay.
So if you guys don't mind waiting a few more minutes so Stephanie can finish the talk. We were running late. I'm really sorry about that.
So
Say 10 minutes.
So we will form a, we will from time to time form a board, but like I think this is a good transition into portfolio management. So if you don't have a board formed and you aren't formally meeting, and as angels you may or may not be going, you most likely will not be part of those board meetings. You may get an update post-board meeting. If there is not a board formed, I think it's a really good practice to get into having those founders just give some standard timeline communication to all of the investors. It gets all of you on the same page. It allows all of us to know what's going on at the company and then begin to not double down in terms of resources. If I need an intro to 3 individuals, I don't need 3 of my investors making intros to the same person. I need 3 different investors making 3 different intros. So little things like that, getting into that pattern can be helpful. Board meetings do help provide some of that structure, but early stage companies, when they don't form boards, helping the founders, begin to give those updates is important. And I think if they can do it for everybody, it does help streamline things and allows you to focus on adding more value as opposed to just getting an update and then, let me try to add value at the end. So just a bit on portfolio management. So this is an art. It's really about how do you get information without interfering in the business. It's not your company. You can't call up these companies every day, every week. How's my investment doing? It is the absolute worst thing you can start to do, right? In a sense, you are not the one running the company. You're not the one making the decisions around the company, and that can be a very difficult thing, especially if you've been an operator before. You want to jump in and you want to help. You really have to think strategically about how you're going to help and how you're going to give advice to these companies in a way that you're not getting in the way of them actually executing on what they need to do. And remember, you're not the only investor in the deal, most likely. And so imagine if you've got, 5, 10 investors, and every single one of them is pinging you every couple of days. How's this going? What's up with this? When am I, when am I going to get, when am I going to get my money back? When am I going to, that just doesn't work. It puts added pressure on the founder. So I think getting to those standardized updates is one important way that everybody can be on the same page in the very beginning. But then also really beginning to feel out from each founder, like what's the appropriate level of contact I need to have with this individual? Do I wait for them to, are they really good at giving me, I have some founders in the portfolio that are great at giving me updates. I never have to ask what's going on in the company. I know every 2 weeks or every 3 weeks, I'm gonna get an email from the founder. It's gonna be incredibly detailed. And then I can actually pick the 2 or 3 bullet points that are most relevant, and I'll do a follow-up call. I'll even schedule a follow-up call, in advance, knowing that I'll get these updates. And we'll spend time diving into those areas where they actually might need help. Or I'll shoot a quick email and say, hey, you need these 3 things. I'll take care of those 3 intros. Let's just be done with this. The less time I can spend with them, the more time they're building their businesses too. They don't have a lot. Again, they still don't have a lot of time. And so that's one piece. There's other founders I never hear from. Those are probably founders you're going to want to ping and try to get them on a more frequent update schedule. Some people, again, it's just knowing the personalities. There's some people that are great on email, and I have we can get through things on email, and we don't need to pick up the phone. There's other founders that really like getting on the phone and having it and talking through conversations. So it is about figuring out the personalities of each of the companies and the founders that you're working with, and the best way to work with them. You also may have preferable ways that you work. And so I think letting people know that this is the best way to reach me is also helpful. I tell my founders, I'm in meetings a good chunk of the day, and I check my email, but I don't respond to email necessarily until later in the day. So I always tell my founders, you've got my cell phone, you can call me anytime, day or night, that you need to ask a question if it's important. Because that's the best way to reach me. So if you're super responsive on email and that's the best way to reach you, let them know. So I think it is about figuring out how to communicate and taking a step back as you've done your first deal or your first couple of deals, and you look at how that communication is working, and you ask yourself, what is it that I can change? How can I communicate better with these partners? So we talked a little about the rules of engagement, how we're gonna do all of this. But I think it's really, really helpful. And then finally, I'm just gonna get to this whole slide so that I don't have to read it from afar. So, just about kind of timing. It takes 12 to 18 months after angel funding to get to that traditional VC round. I would argue it's taking 18 to 24 months now in the environment that we're in right now. There's just a lot of companies getting seed funding, and so the bar is getting higher and higher at the Series A level. So you want to make sure that there's enough money to get the investment off the ground to really begin to show meaningful traction later stage. Basically, the way that you can help them when they go out for funding is helping them with the pitch. Practice listening to the pitch. Every company in our portfolio that goes out to pitch, like they come in, they give us the pitch internally. In a sense, we're also making a decision whether or not we're going to follow on, but really it's a constructive conversation of going through the pitch, refining the pitch, giving them feedback before they actually formally go out. And then one of the most important things we do is we make introductions to VCs. And you know, dirty little secret, I think everybody knows this though, is that's how deals get done. You know, a really good intro to a VC that we're close with moves to the top of the funnel, right? Same with us. A really good intro from a founder, from someone that we trust, goes to the top of my funnel, and that gets to meeting a lot quicker than a lukewarm intro or definitely anything cold. We've actually never invested in anything cold. In the thousands of deals that we've seen at SoftTech, we have never once invested in a deal that did not come through some form of referral or validation. So, you know, and different investors will have different stories, but every single deal we've met has been in some way a referral. And so therefore, you know, when you think about sort of that next round of funding, referral matters. This one I totally co-opted from Jeff. Stay the fuck out of the way if you've not raised money yourself. Just stay out of the way. Let the people that have raised money get involved in helping these companies raise money. You just don't want to intervene if you really don't know what you're doing at that stage. It can be more detrimental. The other thing I'll mention is the intros that you're making for your companies need to be very tight and coordinated. You should not have 5 different investors in the syndicate pinging the same VC. This happens to me actually quite a bit. I'll have a deal that I get 3 or 4 introductions to, and frankly, if people coordinate it, and in many cases these are deals that aren't funded yet, right? So the founder's trying to find 10 different channels to get to me. They 5 of them are like, oh yeah, I know Stephanie. Not all of them know Stephanie all that well. Some of them, when I get a referral from someone who was in my business school class, who works in consulting, who I haven't talked to in years, it's not exactly a great referral because they don't work in my industry. They don't know the deal. They don't, so I actually really care about the quality of the referral. And if I'm getting 5 referrals on the same company, and they're all relatively weak referrals, then that's actually a pretty bad signal for me. So again, as your companies in your portfolio are going out to raise funding, the question is, who are the VCs we want to introduce them to do their follow-on, and who are the right people in the syndicate that can make the strongest intro? And it's not about ego at this point. It's really about what can you do to be most effective for the company. If you have the closest tie to the investor, you're the one that makes the intro. If you don't have the closest tie to the investor, like, I would step aside and let someone else who does have a stronger tie make that intro, because that intro is really, really critical. All right, anything else on... And really the lead's job is to really coordinate and lead the fundraising. So if you're going to be making intros, make sure you're checking back with the company and the lead to make sure that you're not overlapping in terms of that. Final point we'll just talk about really briefly is exit. Great piece of advice we've been given is good things happen to good companies. So you just need to be patient. If it's a good company, don't worry about what the exit will be. Just continue to let that company grow and evolve, and be patient, because a good company will have a good outcome. As angels, you're really along to enjoy the ride. You actually have very different sorts of outcome expectations than we do. You can invest in a $2 million pre-deal, and it can exit for 10 and have a great outcome. That doesn't work for us as later stage investors. I think I heard the last speaker talk about, like, the last thing you want to hear is like a founder sit here and say, this is how I know I'm going to exit. I don't want to hear that either. You shouldn't want to hear that either. It isn't really about knowing exactly how I'm going to exit this company and get your returns back in X number of years. But you do want to know, I think at the end of the day, what does the life of this company look like? What are the possible outcomes for this company? But you do need, if it's a good company, again, you want to stay out of the way and allow the company to grow, as opposed to really breathing down that founder's neck and wanting to know when it's out. And then the final thing to mention is that, depending on how long the company is around, there definitely come to be opportunities as companies grow to sell shares in the secondary market, to kind of clean up cap tables. And so you do have the option to exit some of your earlier investments as they mature into later stage, but still not yet public companies, to not unload those shares, but essentially to get back a solid return for yourselves and be a little bit more liquid. So again, you can put that into more companies. And as you think about a portfolio strategy, that's certainly something that many of you would probably want to do. So without further ado,
we might need to finish.
Yeah, I'm going to end it right now.
Thank you so much.
Thanks, everybody.